Hello, class, and welcome to our 10th lecture series on financial accounting or principles of accounting. And I'm your instructor, Dr. Jamal. Okay, so up till now, what we have covered one part of balance sheet, the asset part, which is cash, like how cash is accounted for. Asset is equal to liabilities plus owner's equity, right? So up till now we have covered the cash, and now today our goal is that we will understand the concept of how we are accounting for the account receivable. Okay, so let's just move on. So our first learning objective is account for and control accounts receivable. So there is some theoretical part. We will go first and then we will enter into some numerical part. So the types of receivables, remember, account receivable is the liquid assets. It's among the current assets, right? We have two types of assets, current assets and long-term assets or fixed assets. Total assets is equal to current assets plus long-term assets or fixed assets, right? So the most liquid asset is cash, and after that we have account receivable, right? Because its age is less than 1 year. It is also the most liquid asset after the cash. So what is account receivable? We already know that this is monetary claims against others. So how it is created? When you sell goods on credit. So remember, the nature is it's a claim against other. How it is created? By selling goods or services. And what kind of goods or services? Credit sales, right? It doesn't include the cash sales, okay? Because you receive the cash, then you don't have any monetary claim on others, right? The second part is there are two types of receivable. One is normally account receivable, and the second one is notes receivable. So a note receivable is basically a note, a business letter provided by the customer that, okay, I am acquiring the goods from you. I will be paying back you the money after some time. For example, the company says the company sold to a customer worth of $100,000 worth of goods. Now company will say that, look, our money is stuck with you for 6 months. You will be paying us after 6 months, right? If we save our money, this 100,000, and save it with the bank, we would be earning at least 2% interest or 3% interest, right? So let's make a deal. You send us the money 6 months, no problem, but you would be sending us this 2% interest as well. So that would be our interest income. We are as a company, okay? So if buyer or customer is ready, then he will sign a note on the business letter that, okay, a business letterhead under his company names and all the stuff, and that is also challengeable by the court, okay? It's not like some simple paper, a blank paper, no. Some company stamp over there as well, right? So what are the entries? Whenever sale occurred, which kind of sale? And normally if I say sales, automatically assume that we are talking about credit sales. If there is a cash sale, then question explicitly mention that, okay, this is a cash sales. Cash is received. Okay? If the question is silent, then automatically assume that this is a credit sales on account. Okay? Then, because in a big business companies, it's rarely happen that all transactions are in the form of cash. Normally, it's a credit sales. Company send you goods, and when the goods are sold, and your customer is sending you the money, you can increase the cycle of the payment by giving them discounts encouraging them to pay early. But it's really happened. It's a part of business practice that all the sales are cash sales, right? So whenever sales happen, what is the entry? Accounts receivable increase and your sales increase. Sales belong to owner's equity under retained earning, right? So remember this, our previous logic for accounting equation. So sales increase, credit, account receivable increase, debit. So entry would be account receivable to sales, right? So if there is a note receivable, then remember simple. Rather writing down accounts receivable, just write it down notes receivable to cash. But only difference is when we receive the cash include also some interest income. We'll see if we have some kind of, some illustration we will see in our coming slides. So if we focus, because the note receivable, it's not issued to every customers. Normally customers pay you in 30 days, in 45 days, not more than that. That is a normal customer. But if a customer if customer needs a more credit period, then they will be charged some interest payments and all the stuff, but normally it doesn't happen. So majority of the account receivables are the account receivables, right? Without any interest income. So we give them credit some periods of time. After that, they will send us the money. That's it. So account receivables are amounts collectible from customers from sale of goods. In some books, normally the old books, which are normally published by some British authors, they call this trade receivables. Trade receivables. Okay. The account receivable accounts serve as a control. What does it mean? Have you go through with this kind of situation in which you go to a shop and you want to purchase and they tell you, please open the WeChat or open the Taobao account or open from Alipay, pay us through some online portal. And you pay that, they also give you some discount as well. Or I'll also give you the facility, okay, you can pay us right now and go home, we will deliver at your doorstep free of cost. Or maybe we will be installing that item free of cost. And have you ever wondered why they are doing that? Because you yourself go to the shop, you are seeing that article, that product you can buy right now, and you can pay by yourself transportation cost and installation cost. But the company is encouraging you to pay through online portal. Have you wondered why? In order to establish control. Control on what? Payments. Control on what? Fairness. So why is that? Because it summarizes total account receivables from all customers plus subsidiary ledgers kept with a separate account for each customers. So you already know that how much sales we have, in our sale account, and how much money we need to receive from customers, right? But in balance sheet, we just write it down account receivable, that's it. But there are like 1,000 customers, a company has 1,000 customers who are ordering and paying you later. So how company can know that how much Mr. Jamal owe to this company, how much Miss Marilyn owe to the company, how much Mr. Harry owe to the company, right? So they have individual subsidiary ledgers. Mr. Jamal has its own account receivable. Miss Nam has her own account receivable. Pinyo has its own account receivable. So account receivable collectively is like you add all the individual accounts receivable together, and then you post a final figure on the bigger ledger account, account receivable, journal account, account receivable. So that doesn't mean that if I am the if a company want to know how much Mr. Jamal own to this company, it doesn't mean that you don't know, because your total accounts receivable are 100,000, and we don't know because our we don't have any transaction. But if you click that one, or if you go to the register over there, we have a subsidiary ledgers of each and every customers, right? So don't you worry about that, how much this customer owe, how we can find out. Everything is fair and everything is precise over there. You just, in an online portal, you just double click and you can find out all the customers that owe you the money. You click over there and you can find out each and every ledger or separate ledgers, the subsidiary ledger of the main account receivable. Or if you have in a manual setting, you have big register and you have some small registers over there. Okay, this is Mr. Jamal, this is Miss Nam, this is Pinyo, this is Dayon, this is Harry, right? So you can open that, but that figure, the final figure of Mr. Jamal will go to the account receivable. Final figure of Miss Nam will go to the account receivable. Final figure of Pinyo will go to the account receivable, right? So that's why it is a main control account, so that on a glance, you can easily find out that how much we want to owe, how much these customers need to give us the money, or what is our claim on outsiders that, okay, we need to collect money from you. Here we go. So this is how the subsidiary ledgers looks like here. So on balance sheet, the journal ledger is going to be account receivable, that the total amount of money that customers need to pay us is 9,000. How much Mr. Brown need to pay us? We go to the Mr. Brown account receivable account. We find out that, okay, this is the outstanding amount, and that belongs to the business, that belongs to the company. Okay, 5,000. Similarly with FedEx, 1,000. Moody's, 3,000. So that is a subsidiary. You add them. So total amount we need to collect from customers, 9,000. So everybody understand that? How account receivable act as a control account for all the receivables? Harry, Marilyn, Nam, Pinyo, Dayon, understand?
Understood.
Good. Okay, let's move forward. A note receivable. So a borrower signs a written promise to pay to the lender a definite sum plus the interest, and there is a maturity date, like I explained to you. So it may require the borrowers to pledge some security as well. If I couldn't pay you, okay, maybe that part of my property belongs to you. You can sell that property and you can claim your money. Okay, maybe this delivery truck belongs to you. Okay, this land belongs to you. You can sell the land, you can take your money back, and rest of the money revert it to me, right? Do we have the example? No. Like I told you, we have the example here. No. Okay, let me give you the example of note receivable. So a note receivable, similarly with like a company letterhead, for example, Jamal and Company.